Let's talk about successful investing in the stock market. Successful investing in the stock market is boring. There's nothing exciting about it. If investing in the stock market becomes exciting, then you are speculating, you are gambling, you are timing the market. Your purpose, your blueprint, your formula for success in the stock market is to achieve the result the stock market gives. Don't try to beat the stock market. Don't try to be smarter than the stock market. The Spiver report tells us, which is a survey, it's an analysis, it's a research of professional money managers, professional financial planners, that mutual fund managers, institutional fund managers, those that do this for a living. The Spiver report looks at their performance, and the vast majority of them, 92%, underperform the broad market index. That's why I want you to be invested in the total stock market index. Most people will say, well, that is average. Yes, but in this case, being average puts you ahead of the professionals. Investing is boring, and you want to put your money, dollar cost average, into a total stock market index. Every paycheck you get, 15% goes into the total stock market index. And you'll keep doing this first year, second year, third year. You keep doing this until when? Until you have about 10 times your annual income in a fund that says total stock market index. And everybody around you will say, that is insane. That's exactly where you want to be. After you have 10 times your annual income in a total stock market index, then you can start thinking of diversifying into bonds. If you're in your 50s, an alternative to that would be to use a balanced fund, especially if you're doing stuff in an IRA. A balanced fund. Look for a balanced fund. A balanced fund invests 60% of its assets in stocks and 40% in bonds. Stocks are an ownership stake in all the companies in the stock market, okay? So 60% of the money in that fund is allocated to owning securities, to owning shares. 40% is allocated to bonds. A bond is basically money that is lent out to corporations. So you're playing both sides of it. You're owning the shares, which is risky, but has a potential for higher return, and then you're lending money to corporations, which is safer. So you balance it 60-40, balanced fund. So option number one is you just pile all your money into a total stock market index fund. If you're closer to retirement, you want to do a 60-40. Invest in a balanced fund. Put your money into a balanced fund, and the mutual fund company, the investment firm, will separate it out. Option number three is to invest in a target date fund that matches the year you intend to retire. and you just keep piling your money in there. You're not picking the best performing stock, the best performing mutual fund. You're not picking the sectors. Trust me, my friends, I have learned trying to outsmart the market. The professionals that have their MBAs, that have humongous computers to help them do these trades, to help them do the research, they still underperform the index to a tune of 92% of them over a 10-year period